What's the difference between a pension, provident, and retirement annuity fund? The big distinction between the three is that you can only join a pension or provident fund when you work for a company. So if you're saving for retirement by deducting amounts off your salary each month, it's most likely that you're contributing to your company's pension or provident fund. A retirement annuity (RA) is different because it is independent of the company employing you. If you run your own business and operate as a sole proprietor, then this is the way you will probably be saving for retirement. You can, however, contribute to a RA via your employer, and in fact, many companies are now switching to RAs because they offer more flexibility and choice for their employees. The main difference between these funds is how they're treated when you retire or when you want to take money out. When a member of a pension or provident fund retires, they can choose to withdraw up to 1/3 of the total benefit as a cash lump sum, while the other 2/3 must be paid out as a pension over the rest of their life. A provident fund member can, however, choose to withdraw the full amount at retirement if they want to. Just to repeat that, the main difference between these funds is how they're treated when you retire or when you want to take money out. When a member of a pension or provident fund retires, they can choose to withdraw up to 1/3 of the total benefit as a cash lump sum, while the other 2/3 must be paid out as a pension over the rest of their life. A provident fund member can, however, choose to withdraw the full amount at retirement if they want to. There is an exception to the above, which applies across all three types of funds. If the entire value of the fund is less than 247,500 Rand, then you can withdraw the entire fund value as a lump sum. Just to repeat that, if there is an exception to the above, which applies across all three types of funds. That means pension, provident, and retirement annuity. If the entire value of the fund is less than 247,500 Rand, then you can withdraw the entire fund value as a lump sum. The other difference is that a member can withdraw from a pension or provident fund at any stage before they retire. Repeat, the other difference is that a member can withdraw from a pension or provident fund at any stage before they retire. However, members of an RA can't cash out before reaching 55 years old, except if they're formally emigrating from South Africa or have all the amount is less than 7,000 Rand. Please note, rules for taxpayers who financially emigrated changed effective 1 March 2021. Taxpayers will need to be non-resident for 3 years before they can access their retirement annuity funds. So just to note, rules for taxpayers who financially emigrate changed effective the 1st of March 2021. Taxpayers will need to be non-resident for 3 years before they can access their retirement annuity funds. How does tax on retirement work? If you're diligently putting money away for your retirement in the form of a pension, provident fund, or retirement annuity, you're probably familiar with the retirement fund tax laws which came into effect on the 1st of March 2016. If you're a little sketchy on the details, here's a quick recap. Before March 2016, the different types of retirement funds, pension funds, provident funds, and retirement annuities each had their own set of tax deductions and limitations, which was rather confusing. However, from 1 March 2016, under the new regulations, all types of retirement funds are treated the same for tax purposes. Essentially, what National Treasury is trying to do is to encourage us all to save more and preserve our funds for longer, well into our golden years. Let's go over all the details. The retirement fund tax deduction. Before the 1st of March 2016, if you contributed to a provident fund, there were no tax benefits, while pension funds and retirement annuities each had their own set of complicated deductions and limitations. As of the 1st of March 2016, though, this has changed. It doesn't matter whether you have a pension, provident, or retirement annuity, or even a combination of all three. You'll qualify for a tax deduction of up to 27.5% of your taxable income, up to a maximum of 350,000 Rand per year. This limit applies to the total contributions you made into all funds for the whole year. Repeat, this limit applies to the total contributions you made into all funds for the whole year. In the case of a contribution to a pension or provident fund via your employer, the sum of your employee and employer contributions count towards this deduction. This means you'll save a significant amount on your annual tax bill, which is a great reason to start saving for your retirement now, if you haven't already. So just remember, in the case of a contribution to a pension or provident fund via your employer, the sum of your employee and employer contributions count towards this deduction. This means you'll save a significant amount on your annual tax bill, which is a great reason to start saving for your retirement now, if you haven't already. Let's go through an example together. Let's say your taxable income, which includes salary, rental income, freelance income, etc., is 20,000 Rand per month, and you contribute 1,000 Rand to a retirement annuity and 600 Rand to a provident fund each month. This means that your total retirement contributions for the year are 1,000 times 12 and 600 times 12, which is a total of 19,200 Rand. Your annual taxable income before deductions is 240,000 Rand, which is 20,000 Rand times 12. This means that you can claim a tax deduction of up to 66,000 Rand, which is 27.5% of 240,000 Rand. You're limited to the total of your actual contributions though, So in this case, the amount of 19,200 Rand can be deducted from your taxable income for the year. Taxable income equals 240,000 Rand. Retirement fund deduction allowed 19,200 Rand. That means your taxable income after retirement fund deduction is 220,800 Rand. So your new annual taxable income is 220,800 Rand. This will be the amount used to calculate your tax and not 240,000 Rand. Under the old laws before the 1st of March 2016, the only amount allowed to be deducted would have been the RA contribution of 12,000 Rand. Under the new rules, you're getting an additional 7,200 Rand in tax deductions. If you contribute above 27.5% limit and less than the 350,000 Rand cap, the excess contributions will be carried over and deducted in the next year. Repeat that. If you contribute above the 27.5% limit and less than the 350,000 Rand cap, the excess contributions will be carried over and deducted in the next year. If at retirement you still have carried forward contributions, then your excess contributions can be used to decrease the tax you may need to pay on any cash lump sum you take out, or to reduce the taxable portion of your living annuity income in retirement. Repeat, if you contribute above 27.5% limit and less than the 350,000 Rand cap, the excess contributions will be carried over and deducted in the next year. If at retirement you still have carried forward contributions, then your excess contributions can be used to decrease the tax you may need to pay on any cash lump sum you take out, or to reduce the taxable portion of your living annuity income in retirement. It's always best to keep a record of all the retirement contributions you made across all the different funds you contributed to each month, so you know exactly where you stand. The taxation of your employer's contribution. Many employers structure salaries in such a way that they make contributions on your behalf to a pension, provident, or RA fund automatically each month. These contributions will be included on your IRP5 as part of your income and then taxed as a fringe benefit every month. You will see it listed on your payslips. However, what's important to note is that these employer contributions will be deemed to have been made by the employee, that's you, and you are therefore also included when SARS works out the total retirement deduction you can claim, as explained above. What this means is that even if your employer pays for it, and you get taxed as part of your salary, SARS will allow you to deduct it as well. Benefits of the March 2016 Retirement Fund Tax Amendments. We like the latest amendments to the retirement fund tax legislation. Here's why. It simplifies the tax treatment of retirement funds by treating them all the same way for tax purposes. The different treatment under the old tax laws was very confusing. It provides a great opportunity for individuals to increase contributions to their retirement funds and obtain bigger tax saving in the process. Employees contributing to a provident fund can now also enjoy a tax saving each month, and therefore potentially see an increase in take-home pay. Repeat the last point. Employees contributing to a provident fund can now also enjoy a tax saving each month and therefore potentially see an increase in take-home pay. Where do I claim for retirement on my tax return? If you contribute to a pension or provident fund via your employer, these contributions will be reflected on your IRP 5. Your employer's contribution will be reflected on the income side and taxed as a fringe benefit, while your total contributions, i.e. employer plus employee, will be shown on the deduction side. Your pension and provident fund details. However, if you contribute to a retirement annuity personally or via your employer, you need to complete the separate section on your tax return for retirement annuity contributions. This must always be done for your RA contributions, whether or not it reflects on your IRP 5. In order to complete the RA section, you'll need to request the IT3F tax certificate from the investment house, which will reflect the policy number and amounts you contributed. In order to complete the RA section, you'll need to request the IT3F tax certificate from your investment house, which will reflect the policy number and the amounts you contributed. Retirement lump sums. Cashing in your retirement fund prior to retirement. If you resign from your job, for example, you can still decide to cash in, withdrawal, your full balance of your retirement fund savings, but you're going to be taxed on the full amount based on special tax tables for lump sum withdrawal benefits. Essentially, the lump sum tax calculator works like this. You get a 27,500 Rand exemption of whatever amount you withdraw. And above 27,500 Rand, you will be taxed at 18%. There is a 550,000 once in a lifetime exemption on lump sum payouts due to retirement, retrenchment, or death. So when you retire and have not withdrawn a lump sum before, then the first 550,000 Rand will be tax-free. Bear in mind, this is only once you retire or are retrenched or on death. You receive the first 550,000 Rand tax-free. It's important to note that all lump sums received from a retirement fund, whether as a result of retirement or not, and from an employer in respect of severance benefit, are taxed on a cumulative basis. It's important to note that all lump sums received from a retirement fund, whether as a result of retirement or not, and from an employer in respect of a severance benefit, are taxed on a cumulative basis. The significant impact of this is that when you eventually retire, the total value of all lump sum benefits received by yourself after 1 October 2007 will be taken into account when calculating the tax payable on your current retirement fund lump sum benefit. So just to repeat that, it's important to note that all lump sums received from a retirement fund, whether as a result of retirement or not, and from an employer in respect of a severance benefit, are taxed on a cumulative basis. The significant impact of this is that when you eventually retire, the total value of all lump sum benefits received by yourself after the 1st of October 2007 will be taken into account when calculating the tax payable on your current retirement fund lump sum benefit. So, if you have had 2 previous withdrawals of 40,000 Rand each, and you have paid tax, 10,000 on each one equals 20,000 in total, you would add the 40,000 to the new withdrawal and work out the tax. IRP 5s for retirement lump sums, withdrawal, resignation, or transfer. If you retire from your retirement fund or withdraw money and receive a lump sum, the fund will apply for a tax directive for you and should issue you with an IRP 5 IT3A. So if you retire from your retirement fund or withdraw money and receive a lump sum, the fund will apply for a tax directive for you and should issue you with an IRP 5/IT3A. In the same way, if you transfer your retirement money into a preservation fund and don't receive any cash in your bank account, the same process will be followed and should still receive an IRP 5/IT3A. It doesn't matter if you pay tax or not, or if you actually receive the money in your bank. The same process must be followed. So don't be surprised to see an extra IRP 5/IT3A from an unknown employer included in your tax return. This is simply the one issued by your retirement fund, and it has details of your lump sum withdrawal on it. The lump sum may be coded to most commonly used source codes of 3920, 3907, or 3915. And it will show on it the tax you paid, if you paid tax. Don't worry, this lump sum won't be taxed again, and it won't affect the tax you pay on your assessment or make any refund owed to you any smaller. Your pension will be taxed in the same way as a salary, as per the normal tax tables for individuals. Your pension provider should issue you with an IT3A, reflecting your annuity income for the year, which will be pulled into your tax return. Unfortunately, what often happens is that the pension/fund provider doesn't take off any tax when paying you an annuity each month. If you receive any money from other funds, or if you are still working, then you may receive a nasty surprise and have to pay in when filling in your return. SARS are looking at making changes to this process so that you aren't going to be stuck with a big tax bill at the end of the tax season. Tax benefits on retirements. Luckily, there are quite a few tax benefits for older South African taxpayers over the age of 65 who have retired or who are still working. Firstly, at 65, the tax threshold above which you begin having to pay tax is higher, at 141,250 Rand per year in 2023. What's more important, those taxpayers who are older than 75 get an even bigger break at 157,900 Rand per year. Given the marked advantage of these higher thresholds, it would appear that SARS is starting to look out for those already in retirement, with the mandatory retirement age in South Africa sitting at 65. It would hardly be fair for taxpayers to be penalized for not being allowed to work anymore by having to pay even more tax on these savings on retirement income. SARS calls these retirement benefits secondary and tertiary rebates. Older taxpayers are also getting a greater interest exemption of 34,500 Rand per annum. To provide an example, it would mean that for a person of 65 years of age, the income from an investment of 2.5 million Rand in a money market account earning about 5% per annum, would be below the tax threshold. This is because the interest would be 125,000 Rand, which is 2.5 million times 5%, and then the exemption of 34,500 would be applied to arrive at a taxable income of 90,500 Rand, which is below the annual threshold of 135,150 Rand. For many taxpayers over the age of 65 and even over 75 years of age, this kind of investment may be their only source of income and therefore would benefit greatly from this much needed tax relief. It's also important how SARS treats the medical expenses of older taxpayers. Unfortunately, at this age, medical costs tend to be higher, and so SARS has allowed all qualifying medical expenses that aren't paid for by your medical aid to count towards the calculation for additional medical tax credit. So I'll repeat that. It's also important how SARS treats the medical expenses of older taxpayers. Unfortunately, at this age, medical costs tend to be higher, and so SARS has allowed all qualifying medical expenses that aren't paid for by your medical aid to count towards the calculation for additional medical tax credit. There are several other obscure tax benefits to being over 65, but these only apply to a small number of cases, while the ones listed above are seen more often. So take heart that as you get older, some things do get easier and you have more money available than you think. How do I know whether I have a retirement annuity or fund? Well, you would either see the difference on your IRP5 or the certificate received from the fund. For a pension contribution, your IRP5 will reflect the source code of 4001. For a retirement annuity, the source code will be 4006. Otherwise, you will receive what they call an IT3F from your fund, which means it is an RA. So you'll receive an IT3F from your fund, which is an RA, or if you receive an IRP5, so your employer contributes, you'll receive, it will show a source code of 4001 for a pension fund and 4006 for an RA. Well, does it matter if I contribute different amounts each month to my RA, or one big amount at the end of the year? No, it doesn't matter how or when you contribute, as long as all contributions are made within the period the 1st of March to the 28th/29th of February, when they will be counted towards your deduction. Do I always get 27.5% deduction for retirement contributions? No, this is the maximum contribution allowed. You'll receive your actual contribution up to a maximum of the percentage of tax-table income or gross employment income. Is a tax-free savings account the same as contributing to an RA? No. A tax-free savings account is an investment where you pay no tax on the interest, dividends, or capital gains. A retirement fund is a way of saving for your future, and you're allowed a tax deduction for your contributions. The difference is that one is an investment and the other is a form of saving. Must I disclose the total amount of my RA certificate or the amount contributed for the year? You must only show the amount you contributed for the tax year when recording your contributions on your tax return. So that means the amount contributed between the 1st of March to the 28th/29th Feb of each year. Is an IT3S a certificate about my retirement annuity? No. An IT3S is for a tax-free savings account and not related to your RA. The IT3F is for your RA and used for your tax return. What if I don't receive the IT3A from my fund? You will need the IT3A showing the lump sum received or any monthly annuity paid to you when completing your tax return. Be proactive and ask them to send this to you in June each year. just before tax season, which normally starts on the 1st of July.